Here's the truth about Florida's home insurance comeback and what it means for your home value. From late 2019 through early of 2023, Florida's property market got hammered. 10 property insurers were declared insolvent during that window, about 416,000 policies disrupted. That's not a headline, that's the official count. As companies failed or pulled back, big brands trimmed exposure too. In July of 2023, Farmers announced it would exit parts of Florida, and AAA said it wouldn't renew a slice of policies. As private capacity shrank, policies flooded into states' insurers of last resorts, Citizens. By fall of 2023, Citizens' policy count peaked around 1.4 million, and a red flag that the private market wasn't competing. In December of 2022, lawmakers passed Senate Bill 2A, a sweeping property insurance reform. That means incentives shifted toward a healthier private market. Now, did it work? Well, early signs say mostly. By 2023, Florida domestic property insurers posted positive net income for the first time in 7 years. By late of 2024, OIR data showed about 83% of homeowners policies back in the voluntary private market. With Citizens around 17%, Citizens' policy count fell under a million by December of 2024 and was down sharply again by mid-2025. On top of that, rate momentum cooled. Multiple sources flagged that 2024 saw the lowest average homeowners rate increases in the nation for Florida. Even some rate decrease filings. That doesn't mean premiums are cheap, because they're not, but the direction shifted. So, why are two new insurers coming to Florida now? Well, in June of 2025, regulators approved two more companies to write residential policies, the National Insurance Company and Florida Insurance and Reinsurance Company. Why would anyone run toward this market? Well, there are three reasons. Clearer rules. SB 2A removed a lot of the legal uncertainty that used to torpedo loss ratios. When lawsuits drop and timeframes are tighter, underwriting gets predictable. The second reason is because of profitability and reinsurance conditions improve. Domestic insurers moved from deep losses to positive results in 2023 and improved further into 2024. And the third reason is opportunity from Citizens' depopulation. Hundreds of thousands of policies moved out of Citizens to private companies. Now, what does more carrier competition mean for the housing market? Well, first, let's acknowledge the damage that has already been done. Insurance costs have been a major drag on affordability. When premiums spike, monthly payments jump, debt-to-income ratios break, and some transactions die. In plain terms, a 10% insurance price increase can push prices down meaningfully as buyers reprice risk. Now, here's the upside. When more admitted carriers compete, three good things usually happen, right? The first is that shopping actually matters. Quotes diverge, discounts proliferate, and some households find real savings. The second is that you have more private options, which means fewer borrowers stuck at Citizens or in surplus lines, which helps loan approvals and reduces deal fallout. And the third is lower or stabilized insurance costs improve monthly affordability. Florida still has some of the highest home insurance premiums in America, even with lower increases. The baseline is high. This comeback is about stability and competition returning. This is not a magic rewind to 2018 prices. So where do professional appraisal services fit into all of this? Look, insurers price risk, buyers price value, lenders price loans. The appraisal sits at the intersection. Here are three residential services that directly help homeowners navigate this landscape. First, you got the pre-listing market analysis. I analyze competing inventory, days on market trends, and insurance-sensitive submarket factors like roof age, wind mitigation, flood zones to pin a defensible value range. This keeps you from overpricing in a zip code where insurers is quieter or underpricing in a pocket with strong mitigation credits. The results are fewer price cuts and a cleaner appraisal when the buyer's lender ordered the report. Then you have insurance replacement cost valuation, or what we like to call the cost approach. This isn't your online calculator. I use localized cost indexes, current labor market pricing, quality condition adjustments, and real-world contractor benchmarks to estimate new replacement costs less depreciation. Owners use this to check coverage limits, discuss endorsements, or negotiate with their agent. Too low and a claim is a disaster, too high, and you're overpaying year after year. And lastly, we also can offer a pre-purchase risk-adjusted value review. Before you write the offer, I benchmark the subject against nearby sales with similar roof types, elevations, and wind flood mitigation features. We model how different insurers price those attributes in that micro market. If two houses look equal, but one has a 2021 fortified roof and shutters, the total monthly cost can be hundreds or even thousands more, and that difference should show up in value. This service has saved buyers from expensive mistakes and helped others win bidding wars confidently. My take is straightforward. In a market where insurance is the swing factor, valuation work must integrate risk realities. If you're selling, buying, or simply auditing your coverage limits, leverage a pre-listing market analysis, a true cost approach replacement study, and a pre-purchase risk-adjusted review. These three services put you back in control. If this helped, subscribe and like, and drop a comment below. We'd love to hear from you. See you in the next one.